Let's review the data and the news which came out throughout the week. Based on the data and the news, I'll try to make a prediction on how the market will move in the short to mid-term. Now first on the data. Core data that came out this week include November retail sales, Federal Reserve rate cut decision, initial jobless claims, Bank of Japan's rate decision, existing home sales data, and core PCE data. Now let's look at the key data one by one. On December 17th, US retail sales data came out for the month of November. If you look at this table, month-over-month retail sales was at 0.7%, which was slightly higher compared to the consensus, which was at 0.6%. It was also higher compared to the previous months, which was at 0.5%. On the other hand, core retail sales, which is retail sales excluding automobiles, rose by 0.2%, which was lower than 0.4% forecast and in line compared to the previous month. Now what this means is that the consumers in the US are still enjoying their consumption power and still purchasing goods on a daily basis despite the Federal Reserve's efforts to cool down the inflation. Public demand during the difficult economic times may be good for the companies, but for the economy as a whole, the demand needs to significantly cool down in order for the Federal Reserve to be in a comfortable position to continue to lower the interest rate. I'm going to get to the Fed's interest rate decision later on in the video, but strong retail sales was a prelude to the Federal Reserve making an announcement to slow the interest rate cut in the future. Now let's move on to the Federal Reserve rate cut decision. As I noted in the market update last week, the Federal Reserve did lower the interest rate by 25 basis points, as you can see in the table. However, Jerome Powell said, quote to quote, "We've been moving sideways on 12-month inflation, and the move to cut rates in recent months allows the Federal Reserve to be more cautious and reconsider more adjustments to our policy rate." What this means is that given the sticky inflation, the Federal Reserve will inevitably have to slow the lowering of the interest rate significantly until the inflation shows a meaningful cool down. Now, as I said multiple times in my previous videos, this was an obvious outcome. I mean, didn't everybody monitor the CPI, core CPI, the PPI, the retail sales? The data was indicating a sticky inflation for months, and I've been saying it for months. I just don't understand why all investors and the market were betting on the market going higher and higher, ignoring the data that was coming out every month. Now, based on the rate cut decision that came out, the market is now expecting the rate to be held constant in January at 4.25 to 4.5%. This is a big shift from the previous projections, where the market expected the rate to continue to go down throughout the course of next year. It is not only that, but if you look at this table, by the end of the next year, the market is assuming that there's an over 80% chance of the federal funds rate staying above 3.75 to 4.0% level, which means that at maximum, they're expecting that there will be only 2 rate cuts or less throughout the entire year. Now, this basically means that the market is finally extremely wary of inflation and expects the Fed to take necessary measures by slowing the interest rate cuts in the months to come. Another data which came out was negative as well. The initial jobless claims came out for the week, and this data represents how many people actually lost their jobs and applied for initial jobless claims. Higher the number means that the economy is weak, and a lower number means that the economy is strong. If the economy is weak, the Federal Reserve has more means to boost the economy by lowering the rate, but if the economy is strong, the Federal Reserve has less incentive to lower the rate. If you look at this table, the initial jobless claims stood at 220,000, which was lower than the forecast and much lower than last week. So given the low jobless number, it means that the economy is doing fine, which means that the inflation will either stay or strengthen, which means that the Federal Reserve will most likely slow the interest rate cut. Next data that came out is Bank of Japan's interest rate decision. BOJ kept its interest rate flat at 0.25%. However, some hawkish members of the committee suggested that raising the rate to 0.5%, reflecting concerns on the inflation as well as uncertainties around Donald Trump's inauguration and the associated tariff plans. As a result, while the interest rate was kept flat, they also signaled that the rate cut will be slowed, which impacted the overall Asia market. Now, moving on to the next data, existing home sales data for November came out on Thursday, showing a 4.15 million sales, which was also above the expectation of 4.09 million. This was also higher than the previous month, which recorded 3.96 million. Now, this also indicates that home sales is still quite strong, and with the home sales taking account of a big portion of the core CPI data, it is also indicating that inflation may stay strong in the near term. As I said earlier, unless there's a meaningful crash in the housing prices, the inflation will stay extremely sticky. Last key data that came out during the week was the core PCE data. Now, the core PCE data is a bit different from the core CPI data, in that while core CPI data focuses on household spending data, PCE data also takes into account of non-households as well. Looking at the data, core PCE for November recorded a 0.1% growth on a month-over-month basis, which was below the expectation of 0.2% and lower than the previous month's 0.3%. This data basically means that based on core CPI data, inflation is still showing a strong trend, while based on core PCE data, inflation is being controlled. The two data can sometimes show conflicting messages given the weightings are different between the two metrics. So with all that, the S&P and Nasdaq were both down throughout the week, with S&P down by about 2.0% and Nasdaq down by about 1.8%. The market went down, reflecting the concerns on the inflation and the interest rate trajectory. Now let's put that all together and see where we are. Let's look at the Federal Reserve table. Taking into account of what happened this week, number one, November retail sales were strong, which indicates that the interest rate cut will be slowed. And number two, 25 basis point interest rate cut happened, but they indicated that the interest rate cut will be slowed. And number three, initial jobless claims were weak, which means that the interest rate cut will be slowed. And number four, Bank of Japan kept the rate constant and also indicated that the interest rate cut will be slowed. And number five, existing home sales was strong, indicating that the interest rate cut will be slowed. And number six, PCE data showed softer numbers, indicating that inflation may be somewhat controlled. So taking all that into account, as I've been saying all along, the Federal Reserve policy is gradually shifting towards Section D. I have also been saying all along that we should really think about slowly shifting from growth stocks to defensive stocks, such as pharmaceuticals and financial institutions. Now, we'll need to continue to monitor how the situation pans out, but as of today, my thesis on the market holds constant that the economy will continue to suffer, with the Federal Reserve, which is becoming more and more hawkish, and the strong consumption power, which is still not cooling down. I'll be back with more market update next week.